Welcome back to my channel, Balance Sheets Matter. In today's video, we're going to be looking at Automatic Data Processing Inc., ticker ADP. This was a subscriber request to do a stock analysis on this stock, but before we get into the stock analysis, make sure to subscribe to my channel, Balance Sheets Matter. I do daily stock analysis videos, and if there's a company you would like me to look at, put it down below in the comments and I may actually look at it. But first of all, what does Automatic Data Processing Inc. do? Well, primarily they're a payroll company, but they also provide various other services around that too. As you can see, other basically management service for benefits, outsourcing, HR services. You can see the full list of all their services on their website. But first, let's look at some top level, high level metrics here. I like looking at their little guru focus value band here. It's showing about fairly valued right now, but we're gonna see if this is somewhat accurate. They have a PE relatively high, what some people may think of about 30, and a forward PE of almost 27. So I've talked about before and done a video before on sometimes how high PE companies can be the best ones to buy. Since a lot of times if there's high PE companies that are consistently high PEs, it may mean they're actually a great deal, but we're gonna have to dive into financials, do a stock analysis, and see if that's true about ADP or not. So now let's jump into the financials here. So first of all, here we can look on the right of their long-term revenue trend and the projections by the average analyst. And you can see in the last 10 years, the revenue is growing about 8% with EPS growing about 13.6%. So this is very solid growth and is one of the reasons why it may explain ADP's higher PE ratio. Next, let's jump into one thing that I like to look at sometimes in a lot of stocks, but is not as relevant for ADP, which I'll explain later. As you can see, the return on invested capital, it looks really bad, but this isn't exactly the case because of how this calculation is done, and I will show you on the balance sheet of why this is the case. Because normally when your return on invested capital is lower than your weighted average cost of capital, if the company has to borrow money or issue shares, it means they're destroying value. This is not the case with ADP. I'll get into it later, so make sure you watch the full video. But let's again look at the revenue here. You can see it's growing very well, just over 17.2 billion right now. And basically that's been leading them a very nice gross margin. You can see in these past years here, they're under 40%. And actually recent years, they've been increasing the gross margin. This is also another fact of why the company may deserve a high PE, since rather than losing their competitive moat, which may mean retracting gross margins, they're actually expanding their gross margins in these last several years. So if this trend continues, this could be very good and justify this higher multiple. We can also see the same thing in their operating margin, and it's actually growing at a faster pace. Well, even way back here, when it was higher, then it dropped after the 2008-2009 financial crisis. It was getting the lows around 14, 13, is up to 22. And the reason why the operating margin has increasing at a faster pace is the selling and general admin expense is increasing at a slower pace than the revenue. So this is a very good sign of a company still in a good long-term growth trend. Expansion is going. So I don't see any, from this at least, any slowdown, maturity happening, and deterioration in the company yet. So all these top level metrics here are really good. Next, it's really important to get into the interest expense, but with ADP, it's a little bit different since they have a whole bunch of interest income. And this is because from their payroll and other services, clients pre-deposit basically money with ADP, and ADP sits on that money and they earn interest. And you can see in this higher interest rate environment, they're making more money from that. So that's really good for them. And even regardless, if we ignore this interest income, their interest expense relatively low compared to the operating income. So this is a really good sign. Although one thing we may have to worry about with ADP in the future is when interest rates get lower, this number may actually go down from the interest income. Although if they're growing the amount of clients they have and therefore the amount of client funds sitting within their company there, we may be able to maintain this. But just remember, as interest rates get lower, it is likely that we could see potentially lower interest income in the future. And then we basically look at the bottom line here. You can see net income has been increasing the whole time. Basically, as we already know, our operating margin and our gross margin were basically growing, and we see the net margin growing as well. EPS is growing as well. And these are all the things you want to see in a company if it's going to have a high PE. They have to have a whole bunch of these factors to usually justify that higher PE ratio. And then we can also see they've been returning capital to shareholders by buying back shares slowly as the share count has been going down over time. So now let's jump into the balance sheet. As you can see, basically on the balance sheet, they're sitting at total assets of $42 billion. But a lot of this is these other current assets of $37 billion, and these are these basically funds that they are holding of their clients for the payroll and other services. And this is where they're effectively earning that interest income from. And this is also what starts to mess up the return on invested capital, because when we go to their total current liabilities, you can see they have $38.6 billion to basically balance this out, because while they're holding that money for their clients, this is also a liability they're going to have to pay out. So without getting into explaining the whole return on invested capital and how that calculation works, when it's looking at the total investments in the company, all the liabilities, this number gets added in, which really isn't an investment by them, and it basically makes the whole return on invested capital calculation go way out of whack. But we look at basically total liabilities, $42.7 billion, total assets $42.17 billion, a fair current ratio of about 1. We can look at their total assets, just under $51 billion, but they do have about $2.3 billion of goodwill. So we always have to kind of take this out of their equity at the end, since goodwill isn't really real in any way, just what happens after you acquire a company. But they have total liabilities of $47.4 billion, and you can see long-term debt a measly $2.9 billion. So that's really good. They're sitting in really good financial shape. This is not a lot of debt. They could take more debt on, acquire more companies, leaves them a lot of opportunities, and this leaves total equity of $3.5 billion, and that's more than the goodwill of $2.3 billion, I think it was, but it only leaves them tangible equity at the end of the day, sitting at about just over $1 billion. So the balance sheet overall pretty good. It's not spectacularly great. We're not seeing any way big additional amount of equity sitting on it, but I do like their low overall long-term debt, which is basically really good. But it is important to understand where basically the excess current assets are coming from, as I was going on about here, because that's a very large portion of their balance sheet, and the excess total current liabilities. So now that you understand that, let's go down to the cash flow statement. So we basically see on the cash flow, we can see overall cash flow for operations has been going up. They do a little bit of stock-based compensation, but they are buying back more shares each year, which is why they're reducing that. It's also just good to check out basically if they see any anomalies in their cash flow of depreciation against their purchase of plant, property, equipment. This looks like pretty standard. They're more or less purchasing stuff at the same rate they're depreciating at it. It's not any big variance in that, because that can sometimes tell some stuff, which we notice in some stocks if you watch my previous videos. And along the way, you can see they do these little strategic acquisitions. So it does seem like they are using their money well. They're not trying to buy really big businesses and this and that and spending way too much money on acquisitions, but they're doing strategic ones that grow their overall product line and, continue the business going, which is doing very well. And then as we go down, you can see how much money they basically put back into repurchase of stock. I also forgot to mention they do pay a dividend, and you can see that basically cash flow from dividends are upping that dividend as well while they're buying back stock. So that's increasing your share of the company and the relative amount of dividend you're getting all the time as well. And you can see basically free cash flow all the years, all positive. It's all good. But the real question is, everything's looking really good here. Is this actually a good value to pay for the stock? So let's go into the interactive chart here and do a little bit of relative analysis. And it's not quite as easy as some of the other ones. But first of all, I just want to kind of bring up the revenue with estimate here. Kind of you see where that's going, the direction we're increasing at. And when we bring up the price to sales, you'll notice this is one of these companies that's basically going in multiple expansion, and you may think, wow, it's getting overvalued because the price of sales is getting higher and higher and higher. But this is not really the case, because what is actually happening is the net margin is expanding as well. So as the net margin goes up, you're going to have a higher price to sales ratio, because when the net margin goes up, your price to sales has to go higher to keep the PE basically the same ratio. And you can see over this period here, basically net margin has been growing. Like way back here, we're looking at 12%. It's pushing 20 now. So when you have these multiple expansion companies, because their fundamentals and net margins are growing as well, it can be sometimes hard to figure out what a good PE would be, or a good price to sales would exactly be. But you can see as this is going, we're kind of, in a way, we can do a little bit of, technical analysis on the little channel here and just kind of show the trend this is increasing on. And this will keep on increasing as long as their net margin keeps increasing, until basically it stops increasing, and then they're going to find a range where they're basing in, but higher lows for the price to sales ratio. So when it gets to the lower side, that's probably the better deal. If the net margin basically stops increasing, we would start expecting this to go sideways. And then we go look at basically the stock chart. The reason why I have this here is just to show at their ultra long-term trend here they've on, basically the stock has been increasing at about 13% per year, which is actually fairly in line with their EPS growth. So they kind of are increasing with their actual fundamentals. But with companies like this, because there is so much certainty with them, you don't get a lot of actually price variance in the stock. You can see, well, there is this trend and you get dips and this and that. It's not nearly as much as other stocks, which actually does make it really hard to get these stocks at really, really good deals. But if I were to basically buy the stock, which I might in the future, I would personally wait for it to come down into some of these moving averages here. Maybe the red 100-week moving average or the yellow basically 100-week moving average, anywhere there. Maybe a little bit more attractive point, because maybe if you're buying it now, you're probably going to get the average inline returns possibly in the future, which is about 13% per year, plus the dividend they're paying out. I'm just going to actually quickly look at the dividend they're paying out. I don't think it's that high because they have a high PE. And yeah, you can see it's about 2%. So with the 2% dividend, the 13% growth, if everything continues going forward well for ADP, probably a 15% year compounder, although it would be nice buying it basically on a dip, because if you are able to effectively buy these companies on a dip, you can get this extra undervalued premium on top of that as they grow along. So I hope you like this video. I hope the analysis basically gave you a little insights of why ADP probably does trade at a high PE and maybe probably does deserve it. And if you're interested in more stock analysis videos, make sure to subscribe to my channel, like the video, and I'll see you in the next stock analysis.